Hi everyone, and welcome to my channel, where we are all about empowering you with the knowledge to make smart financial decisions. And today, we are diving into a topic that could seriously boost your investment portfolio: interest rate cuts. Now, I want to ask you a question. How can you profit from the upcoming interest rate cuts? I think one of the promising areas is real estate investment trusts or REITs. In this video, we will explore how REITs work, why they tend to thrive when interest rate falls, and how you can position yourself to potentially benefit. At the end of the video, I will also analyze the increase of dividend return if the rate cut by 0.25%. We have established that interest rate cut can be a big deal for certain investment. Now, let's talk about one of the key players in this scenario: REITs. What actually are they? Well, in simple terms, a REIT is a company that owns and, in most cases, operates income-producing real estate. Think of them as a pool of funds that especially used to invest in real estate. REIT usually invest in real estate such as hospital, retail mall, office tower, or industrial estates. Here how it generally works. Investors like you and me can purchase unit in a REIT. The REIT then uses that capital to buy a variety of property. This property could be anything from office building and shopping malls to hospital and apartment. The property has tenants that pay for the rent, and the REIT distribute back to you and me as unit holder. And here is that key. REIT are required to distribute a significant portion of that income directly to their unit holder. For Malaysia, it's at least 90%. This is why REITs are often favored by investors seeking steady income. Then we have trustee, which represent as unit holder. They hold the legal title to the asset, but unit holder is the beneficial owner, and of course we pay fee for them. We as unit holder own a fraction of property. I like the anecdote is I own a fraction of a retail mall, toilet or brick if I own a retail mall REITs. The tenant of the property then pay for their rent to REITs and we benefit from it. Then think of manager is a manager that you hire to help you to monetize the property and see anything to improve, and we pay for them management fee as well. Property manager is like a third party company that operate specific property. Usually they have specialized expertise that help the operations. Malaysia has a rich and diverse landscape of real estate investment trusts that can cater to various sectors of the property market. Each type of REIT serves a distinct purpose and offer unique investment opportunity. So let's explore some of different categories. Commercial REITs. This sophisticated investment vehicle specializes in managing and operating office building and business space. Notable examples include UOA REITs, which maintain a portfolio of great office property, and Tower REITs, known for its commercial assets. And beside that, we also have retail REITs. These REITs focus exclusively on shopping center and retail space, from neighborhood malls to premium shopping destinations. One of the examples is IGB REITs, which operates the most prestigious shopping center, which is the Garden Mall and Mid Valley KL, and also CapitaLand Malaysia Trust or CLMT, which has diverse retail portfolio. Furthermore, we have industrial REITs, specializing in manufacturing facility, warehouse and logistics center. This REIT play a crucial role in supporting Malaysian industrial growth. Axis REIT stand out as a pioneer in this sector, while AME REITs represent the new generation of industrial property investment which focus more on Johor industrial property. The Malaysia REITs market has further evolved to include specialized sectors such as healthcare REITs, represented by Al-Aqar REITs, which focus on medical facility and hospital, and hospitality REITs like YTL REITs, which manage a portfolio of premium hotel and resort. Understanding the distinct characteristic and market dynamic of these different REIT category is essential, as their performance can vary significantly based on economic conditions, sector-specific trend, and market cycle. Now, let's go to the heart of the matter. How do interest rate cut affect REITs? To understand this, we need to look at the mechanics of how REITs operate and how they work. So basically, the revenue of the property can come from rental, car park fee, and other income. And this shows how good for the property to produce rental income for the REITs. And of course, we have some expense to spend on. The expense is about the maintenance fee, quick fee, and upgrading fee, as well as utility. And last, we have borrowing costs. It's the cost or interest when they finance to buy a property. Then we get the profit after subtracting expense and borrowing costs. During the interest rate is going up, the borrowing cost of many REITs going up too, especially 2022 to 2023. And some of the REITs revenue cannot increase faster than the borrowing costs, resulting in low profit. Thus, we need to think carefully and buy REIT that own high quality property only. Now, we dive into the impact of interest rate cut is lower borrowing costs. REITs often use debt to finance the purchase of property. When interest rates are high, the cost of borrowing that money is also high, which eats into their profits. But when interest rate falls, the opposite happens. Lower interest rate means lower borrowing costs for REITs. This can lead to significant savings, especially for REIT with large portfolio and outstanding loans. And beside that, it also increases distributable income. This is where it gets really interesting for investors. Because their expenses are lower, REITs have more money left over from their rental income. And since they are required to distribute a large chunk of their income to unit holders, this means you as a REIT investor could see high dividend. Lower interest rate not only benefit REITs directly but also increase the value of the property they own. When interest rate fall, it becomes cheaper to get a mortgage, which can increase demand for real estate, and this increased demand can drive property price higher, which in turn benefit REITs that own those property and the value of property discount. All of these factors combine to make REITs a more attractive investment when interest rate decline. The higher yield and potential for capital appreciations make REITs more competitive compared to other fixed income options such as bonds and fixed rate deposit. So, in a low interest rate environment, we tend to see more investors turning to REITs in search of attractive returns. Just ask you a question. Are you still going to place your deposit when the interest rate is just 1 or 2%? So usually REITs borrow money with fixed rate and float rate with certain percentage. A fixed rate loan has an interest rate that stays constant throughout the long term. This means the borrowing cost remains stable and predictable regardless of whether the central bank took interest rate. For floating rate is borrowing with float interest rate. They change when the central bank cut interest rate. When interest rates are cut, REITs with floating rate loans directly and immediately benefit. Their borrowing costs decrease, leading to higher net income and potentially larger distribution to unit holders. So, in order to maximize the return of dividend due to the interest rate cut for company that has high float rate, and the question is, who has the highest percentage of floating rate compared to fixed rate? in Malaysia REITs. So this is some of the disclaimer. Before we dive in,